Are you an accounting or tax professional who wants to stay ahead without spending a dime? Join thousands who trust insightful accountant and tax practice news to keep them informed and empowered. Get expert updates on QuickBooks, Xero, tax planning strategies, and workflow tips delivered straight to your inbox. Whether you're a solo bookkeeper, firm leader, or tax advisor, these newsletters are your shortcut to what's next in the profession. They're free, practical, and built for people like you. Visit insightfulaccountant.com and hit subscribe to start your smarter workflow today for free.
Hello, and welcome to day 2 of this month's tax-focused Future Forward webinar series. Today's session is the Tax-Ready Bookkeeper. My name is Emily Frowls, and I'm the host of today's session. Our presenter for today is Nancy McClelland, although some of you may know her as the Dancing Accountant. She will walk through the practical tax essentials for bookkeepers to spot issues, improve CPA collaboration, and deliver more value.
Thank you so much, Emily. I really appreciate that. That cruise sounds fabulous. I was just squinting my eyes looking at who's going to be presenting on that, and that looks absolutely incredible. Plus, who doesn't love learning about accounting while they're at sea? I mean, great long tradition. Thank you so much for having me here. I'm a huge fan of what you're doing, and that's why I'm an advisory board member of Insightful Accountant. We share a passion for educating bookkeepers because it literally makes everyone's life better. Their clients and the communities they contribute to, the tax pros they work with, and of course themselves and their families. So I'm delighted to be here with y'all today. Thank you, especially to our sponsors who make all of this free education possible. We've got some learning objectives. We're going to talk about book versus tax income, why entity choice matters, and some of the mysteries of communicating with tax pros. But what is cool is that we're going to get at all three of these by discussing how to perform a review on your client's financial statements before handing them off to the tax preparer, which I argue is the most foundational element to preparing tax-ready books so that you can feel empowered to be the all-important link between your client's needs and the CPA's demands. And let's start by finding out who is in the room here. Do you self-identify as a bookkeeper, a tax pro, or both? So bookkeeper is A, tax pro is B, or both is C. And if you're neither, then I'm guessing you're in the wrong webinar, but we're happy to have you anyway. So just pick whatever you want. It doesn't matter. And Matt, when you've got enough responses and we've got a sense of who's in the room, I'm really curious. Oh, got some. Oh, and make sure you're answering the poll, not just in the chat, in the poll. What do we got? All right, it looks like we've got about 63% bookkeepers, 10% tax pros, and 27% both. Okay, this is really great because this content was written for folks primarily who are bookkeepers working with tax pros. However, one of the things that I love to teach is to teach tax pros how they can better collaborate with bookkeepers. And all of this stuff, the reason it became important to me in the first place is that these were things that we had to figure out how to do in our own firm. And we are both bookkeeping and tax. And so we had to figure out how to get those kind of two sides of the chasm to communicate with each other. So we've got a really good blend of folks here. And Deborah is just killing me in the chat, y'all. She is so hilarious. Speaking of the chat, I wanted to mention that if you have a question that you would like answered, I am going to save all Q&A for the very end. So please use at the bottom of your screen in Zoom, use the Q&A function if you have a question that you would like to ask. However, if I say something loopy and you're confused and you need me to clarify, put it in chat and Emily will try to interrupt me and make sure we get some clarification. Hi, Jessica. Oh my gosh, so many wonderful people in the chat. Give a shout out if you know me or if you've seen me before or if you're in Ask a CPA. I want to say hi to you. Speaking of wondering who's in the room, for those who don't already know me, I'm Nancy, the Dancing Accountant, and I started my own bookkeeping firm almost 25 years ago, which is kind of amazing. Hey, everyone. Oh, I'm seeing all the love in the chat. It's so good to see you. So this was way before becoming a CPA that I started my bookkeeping firm. And then it was about a decade ago that I became a CPA. I write an award-winning blog, which just celebrated 10 years, which also feels impossible. But more important than the awards are the fact that my friends and bookkeeping buds often say that when they Google an accounting question, they'll get my blog as one of the main search results. So that's even better than the awards because it's reaching the folks who I write for. And what happened was I realized I could help exponentially more small businesses if I not only supported them directly with our hyper-local firm here in Chicago, but also if I supported the people that help keep them healthy and by extension, their communities. So that turned into an MSN column. There's a QR code on the next slide where you can subscribe to that for free. And then that inspired me to start the Ask a CPA community, where bookkeepers can ask me the questions that for whatever reason, they don't feel like they can ask their clients' tax preparers. Or maybe they tried asking and they got radio silence. That happens too. So to learn more, you can go to thedancingaccountant.com and click on the Ask a CPA header, or you can email me here if you have specific questions about the community. It's askacpa@thedancingaccountant.com. Our tagline is knowledge is power, so keep asking questions. There are a bunch of members in the chat. I just saw some of them are in the audience. So, if you've got questions and you want to ask them about it, feel free. They'll give you the real deal on it. And that QR code on the screen is not actually a sneaky way to download all of your social security numbers and bank info. It's just my contact page on my website where you'll see a bunch of different logos that you can click on to connect with me and learn about the different projects that I'm doing, Ask a CPA or the She Counts podcast. Or if you want to connect with me on LinkedIn or subscribe to my MSN column or all of the different things, they're all on there. All right, let's get this party started. Is everybody excited to learn about taxes? Woo! Yeah, no? Okay, I never know if that's going to work, but you can't blame me for trying. So let's get this straight. I don't think taxes are boring, okay? I don't think taxes are boring, but more importantly, that's entirely beside the point for this session because we're not talking about doing taxes. We're talking about how to up your bookkeeping game, be a hero to your client, and get more and better quality business. So we're all bookkeepers and accountants in here. And a few of the things that I know about us are, number one, we love learning how to follow rules. We are rule followers and we love it. Number two, we love getting things just so. We're not sloppy, right? And number three, we love our clients and we love trying to help them. What we don't love sometimes is the relationship we have with CPAs and EAs and other tax preparers and the way they sometimes treat us, yeah? So I want to figure out some ways to make that better while helping our clients at the same time. You are not alone. The relationship between CPAs and bookkeepers is, I don't know, some call it complex. I call it super crappy. And to illustrate, I want everyone who has ever been treated condescendingly by a tax preparer to type the word me in chat. I'll give you a moment. And if you're a tax pro, I want you to answer this too, because I get treated this way all the time, and I've been a CPA for over a decade. Me again, me. Yeah, And if you're brand new to bookkeeping and you don't know how to answer because you haven't worked with a tax pro yet, don't get nervous about this. We're going to make sure you learn to lead this relationship. Let's see. That's another me. Take a look. You are not alone. I see you. I get it. I've been there. I feel like tax preparers and bookkeepers are in this elaborate dance together, like Fred Astaire and Ginger Rogers. Now, they're both concerned with helping the client. They're both concerned with compliance. We're rule followers. They're both trying to add value. But one of them is Fred, calling the shots, getting the credit, having the last say. And one of them is Ginger, as the saying goes, doing everything he does, but backwards and in heels. So can you guess which one we are as bookkeepers? So my wish for you is that slowly over time, you start dancing like partners, anticipating each other's moves, communicating and improvising, and working together on choreography. And if not, if they don't like your personal technique, you go find a new dance partner. So let's go to poll question number 2, Matt. What has been your most challenging issue with Tax Pro Bookkeeper collaboration? And your choices are source document organization, lack of communication, or quality of education. These are the 3 that I see most often. There are lots of other reasons, but these are the 3 I see most often. And I'm really curious to know who in our group here has experienced each of these, but which is the worst? You've got like a tax pro wondering where the bank statements are. That would be source document organization. Or you have duplication of efforts because the bookkeeper already tied out the 1099-K, but the tax pro didn't ask for the work papers. And so there's a lack of communication there. Or you've got bookkeepers who don't know what's expected of them or how to handle complex issues because no one's going to take the time to teach them. All right, so we've got source doc organization, 15%, lack of communication, 58%, and quality of education, 27%. That is really good to know. Matt, can you keep a note of this and give me these afterward? Because I want to dig into this further in the future. That's really interesting to me. All right, so to reiterate, you are not alone. So throw your answer in chat. What does it mean to you when you hear the term tax-ready books? What does tax-ready books mean? There are so many angles. Just start throwing them out. Oh my gosh, I love Robin's comment. What about CPAs who don't understand the proper process to correct errors? It's not always a journal entry. We're actually going to talk about that. All right, match the prior year return, accurate, balance sheet tied out and reconciled. All the info is there and there's proof that it is correct. All reconciled accounts. Anything else? Balance sheet accounts reconciled, good. All accounts reconciled, ready to enter into the tax return, closing journal entries done, balance sheet reconciliations. What about the P&L? Could do the tax return without any extra cleanup needed and with minimal additional entries. Depreciation and distributions may be all that's needed. Liz, that is an excellent, excellent response. We provide the source docs and the quarterly payroll reports to CPAs for our clients. That's another really good one. Financial reports organized to help business owner make decisions and tax pro efficiently file. I love all of these. So do you hear how many of these things are related to having a solid set of financial statements? I mean, go back and look at all of these responses in chat. Right? The foundation of this concept here of tax-ready books, the one thing that would make the biggest difference in the quality of your handoff and in your client's return is reviewing the financial statements. Susan is saying reconciled, categories reviewed, personal items reported correctly. Purvi says identify transactions that will differ in book and tax treatment. I love that one. Yes, these are all related to having a solid set of financial statements. Now, there's more we could talk about if this were a long day session or a day-long session, but it's not. So rather than fire hosing you, I am going to give you the most essential stuff that makes this feel doable and achievable when you start applying it. And if you've ever attended one of my talks, you know I have way more to say than I could ever possibly fit into a given session. So I'm going to hold off on Q&A, like I mentioned, unless you need something clarified in the here and now, in which case toss it in chat and Emily will interrupt me if it's time sensitive. And my guess is that you'll have more questions once you start applying this process to your clients' books. So to make it easier to follow along and reproduce this stuff while you're working on a real client file, since we only have an hour together today, we've got a special free download for the Insightful Accountant community. So let's toss this link in chat. Actually, Emily, I meant to give you this link beforehand and I didn't. So I can't toss this in chat. So if somebody else wants to,
Absolutely. We'll take care of it.
that would be great. And actually, Emily, if you wouldn't mind sharing this a few times throughout so that if somebody doesn't get a chance, if they don't have enough time right now to download it, they can get it at some point.
Absolutely.
So this is a simplified version of our Ask a CPA comprehensive 2-page bookkeeper's guide to annual reviews. So if you are in Ask a CPA, you don't need this copy. Go into our resource section and download the 2-page one. It's more thorough, but this is a simplified version of this. This is most of the way there. So this is just to make the process I'm about to walk through easier to duplicate on your own, because you're probably like writing notes, you're going to be absorbing tons of information. This will make it so that you kind of have a checklist to follow through when you're actually trying this on your own with a client file. So I'm not going through this step by step today. We only have an hour. That's a longer session, but we are going to be talking through the basic process. Thank you, Jessica. I agree. It is an amazing resource. And did you miss the link? No, it's up there on the screen if you want to start typing it into your browser slowly. Oh, there goes Emily. It's in the chat now, and she's going to share it a few more times throughout our session. Okay. So, why do we make year-end financial statement review the key focal point for preparing tax-ready books? It's like a built-in set of objectives that will help guide you when you get back to your office. When you think of everything you do in the books in terms of the financials, it guides your day-to-day, your document collection, your SOPs. Everything you do becomes aligned with it. And you have a little runway time between now and year end. You can do test runs, create work papers and templates, let your client CPAs know you're changing your approach, set up meetings with them, and so on. Also, there are both downstream and upstream effects to this approach. Downstream, meaning it'll help you have a better relationship with the CPA, a value add to the client, increase fees, start offering advisory. And then also upstream, so going back the opposite direction, not only can this approach help you get your next client, but also start that relationship strong. You can ask for prior returns, entity type backup, operating agreements, all of that good stuff. You ask for all of this stuff ahead of time, and then use it to build a chart of accounts and a process that will make your year-end review easier. So here's the process that we're going to cover. We're going to prove the balance sheet. That was the number one thing that I saw in the chat when people said, what do tax-ready books mean to them? That's the best answer you could give if you're going to give one answer, because it means a lot of things. But proving the balance sheet is number one. And then we're going to review key P&L accounts. And then we're going to make sure we create work papers and communicate those to the tax preparer. And yes, I am going to elaborate a little more on asking for the operating agreement. Why is that important? We're going to talk about that a little bit later. Thank you, Liz. Proofing the balance sheet. Let's do it. What does it mean? What the heck does proofing the balance sheet mean? It means making sure that each balance sheet account ties out to a source and that we've documented it. For example, exporting the balance sheet to Excel and just writing a note on each line. If we do one thing to help our clients get an accurate tax return prepared, this is it. So if you think I'm boring and you want to leave, you're cool, because you learned like the one thing you needed the most today. Just export that balance sheet and write a note on each line for the tax pro telling them where the source document is, whether there's something weird you need to know about it, and just show them that you've looked at every single line on the balance sheet. Because if the balance sheet is correct, the net income on the profit and loss is correct. Even if like 100% of everything is sitting in one account, like you all have that client where like literally everything is in the Ask My Accountant one. Yeah, just make sure Ask My Accountant it's on the P&L, because if the balance sheet is correct, your net income on the profit and loss is correct, even if it's all in the wrong place. And that's because net income from the bottom of the P&L is a part of equity on the balance sheet. It feeds into that number. The accounting equation is magic that way. So why do it? Some of our clients don't even have a balance sheet on the tax return. So why are we putting all of this effort into proofing the balance sheet? And the reason is to protect our clients and to have pride in our work. The tax gap is widening. The gap between how much people should pay and how much they actually pay, that's getting bigger. And you can be a part in making sure that accurate tax returns are filed. Also, taxes have become way more complex since TCJA and OBBBBBBA, and they're getting harder, not easier. And sadly, there is just simply no time during tax season for a preparer to dig into the books. We don't have that. It's a luxury, right? We do not have that. Also, you may or may not know that tax preparers are legally allowed to rely on the books provided by the client, unless something looks wrong. And let's face it, a lot of them just blow past that stuff that looks wrong too. So you just don't depend on them to catch things. It's not their job, technically, which means you're going to get the finger pointed at you if something makes it past them. But on the other side of that coin, the happier side of that coin, you'll also get that tax preparer referring clients to you if they see the high quality of work that you're handing off. So you've exported the balance sheet to Excel and you write ties out to bank statement reconciled, or credit card statement reconciled, or reviewed AR aging and customer balances are accurate. Whatever, you're writing each of that on all of the obvious rows. You've checked to make sure depreciation was booked for last year. That's something that sometimes gets skipped. And you've checked to make sure that the fixed assets still match the tax return. These are the basic things that I'm guessing everyone here either already does or can figure out pretty easily. But what about the accounts with weird balances that are not obvious? Negative balances, for example. Maybe it's just timing, or maybe you have an actual issue that needs troubleshooting, like a liability account where something never made it onto the payroll deduction, right? My point here is that once you figure it out, whatever the reason for the negative balance is, once you've actually dug in and you figured out, you gotta note it. You gotta write it on that column of notes that you're handing off to the tax pro, even if it is just to say, yeah, this is real. It clears out the next month, right? Because otherwise, a good tax preparer is going to either question your ability because they're going to see this negative balance and be like, well, that can't be right. Or they're going to duplicate your work and try to figure out why there's a negative balance there. So just let them know. Yeah, I got this. Next, cash versus accrual issues. Review the financials on the same basis that the tax return is using. There's a checkbox on the return that says which it is. The books may look great on accrual, but then you toggle the cash and you get like unapplied cash bill payment expense and crazy stuff like that. These have to be sorted out. You cannot leave them like that. Okay, I'll admit I have left them like that and written it on the tax return like that in a desperate situation where it was like the last day of the extended tax return and I still didn't have what I needed for the client. But that's in the past because I don't work with clients like that anymore. These have to be sorted out. They're usually timing related, and the balance sheet in particular has to make sense in their tax basis that they're filing in. Keeping in mind that QBO journal entries don't toggle, though I believe that Oracle. So keep that in mind because it's beautiful stuff, but you got to understand which ones are which, and you got to actually journal entries.
Sorry to interrupt. We've got two is not booked from prior years. And
great question. Yes, I'm going to answer that one right off the bat, which is reach out to the tax pro. If you don't have those entries, reach out to the tax pro and say, hey, I want to give you the books for this year, but I noticed depreciation this year.
And then if they don't communication with their tax professional, what then?
Ooh, well, I would get the client to switch tax pros. I mean, that's like really, because like, what are you supposed to do with that? Right. So I would just say, throw yourself into trying to make it happen. And I do have one recommendation on there. Get the client to participate in this process. I have a webinar that I recommend you go to. If you're on thedancingaccountant.com, and you like mouse over the different things, one of them is called presentations and podcasts. And it's got a huge list of them in there, and you can go watch whatever you want. And there's one that I did with Financial Sense Workflow Con last year on Bookkeeper Tax Pro collaboration. And there are a lot of really good ideas in there. And one of the things I suggest is getting the client to participate in the process. And I did a podcast with Hannah Smolinski from Clara CFO. You guys might know her from YouTube. And it's in that same list. And that's something you can send to your client and say, look, this lady, this CPA who runs this community and does a lot of education in this space, she wants you to help the bookkeeper and the tax pro collaborate. Can you please listen to this podcast or watch this podcast? Because it's got a lot of really good ideas. So those are two resources that are free that are on the website, Workflow Con from last year and the podcast with Hannah Smolinski from Clara CFO that is client facing. So there's some ideas there. Is it a fair expectation that CPA will provide adjusting journal entries from a tax return? I would say they should, but a lot of them don't. You really do have to ask sometimes. And we'll talk a little bit more about that later. So let me see, where was I? My recommendation is that when you can, use credit memos and other proper workflows instead of being lazy like me and just booking a journal entry for everything. Now, this is a question we got earlier. Let's try to teach the tax pros that you should not cram everything into a journal entry. And one of the tricks is closing the books with a password before you give them to the tax pro. Close the books so that they have to ask you to open them in order to make their adjusting journal entries. Or you can say to them, hey, could you make sure to give me your list of adjusting journal entries at the end when you're done, and I'll book those for you. Okay, that's a little trick that I have there. You'll be able, if you're looking at those adjusting journal entries and you see that something's hitting AR, you'll be able to be like, that is not the right way, because you're the expert at bookkeeping. Tax pros are rarely experts at bookkeeping. I happen to be lucky because I started as a bookkeeper and then became a CPA. So I know how to do both, but most do not. And they shouldn't have to, right? Like, that's not their job, is not to do QuickBooks. Some of them, that is their job, but most of them, that is not their job. So it should be your responsibility, if you can get it, if you can pull that away from them, to make those adjusting entries and to make them properly without just shoving everything into a journal entry. If you do have journal entry accruals, you might want to note them for tax purposes so that the preparer can Schedule M them, which means making a tax return only adjustment. We love to use code in tax, form names and things like that. Schedule M, when that gets used as a verb, it just means they're making a tax only adjustment. So let's say, for example, that you've accrued insurance or you've accrued payroll or something like that, but the client files their books on cash basis. If that accrual was a journal entry and you toggle, if you're in QuickBooks, you toggle that to cash basis, it's not going to reverse that entry. It will in zero if you mark it correctly. And so you need to make that note for the tax pro. Be like, hey, FYI, here's a list of all of the things that I accrued. You'll need to Schedule M these. That's a great way to say it. They'll be impressed that you know the lingo. Another thing that we see is the balance is not tied out to the next payment. So this is a huge problem for sales taxes and similar accounts because it's not easy to see, right? Because they keep collecting receipts in the next month. So you don't always notice that it's not clearing out to zero. I got into big trouble once with a tips payable account that was not clearing out. And I figured, oh, the client's just doing something, they're booking something wrong, right? And so I didn't look into it, and I didn't look into it, and I didn't look into it. Okay. It turned out that we were calculating them wrong, and I had to pay the client back over $20,000. Right? Like I wanted to vomit. If we'd been doing it monthly, we would have caught it early on, right? So don't be me. That's basically moral of the story there. Loan accounts. We tend to breeze past these, especially when we don't have documentation from the client. Now, Liz was asking earlier about documentation like the operating agreement. This is documentation like promissory notes. Do not take their word for whatever loans were made or taken. Do not. Your clients have no idea what they are signing. They have no idea. It's so sad. And if they don't have one, help them create one. You can't create the loan, the promissory note for them, but you can point them to resources on the internet. You can point them to your favorite small business attorney. You can even help them pick the right interest rate. In Ask a CPA, one of our resources is calculate the lowest possible AFR that the client can use on a promissory note when they're lending money to themselves. It's easy to do if you know how. Amortization schedules versus lump sum term loans versus on account. If you know what kind of loan it is, you can at least see if the transaction versus pay interest. It's really finicky, especially where real party concerned. It's 1099 interest expense forms, or interest income forms, are issued on cash basis monthly with the passage of time. The interest reconciliation's a pain because you've got interest expense on the P&L and journal entries to accrued interest on the balance sheet. And it's hard to see what was really paid out during the year, but it's really important. It's so important, especially because interest accrued on an owner loan can't be deducted on a tax return unless it was actually paid out. So you'll want to point this out to the tax preparer. And one of the things I recommend doing, and what we do in our firm, we just have a sub account for related party interest so that we remember to look at that. And so the tax pro, if they're looking at the financials, goes, boom, oh, that pops out. I want to look at that. I want to see whether that got paid out in cash or not. All right, entity types. This goes to Liz's question. A bookkeeping colleague did a consult with me about how to change when her client changed entity types. And we started, as I always do, with reviewing the actual documents that show what kind of entity he was, and the documents that show what the agreement with the other partners or shareholders in the organization are. That's why you want both the entity formation documents and their operating agreement. That's the reason. It all comes down to entity type and how distributions are being allocated. All right. So we started, as I always do, with reviewing these documents. And this made us realize that the owner had changed entity types twice since starting up the company. So he's one thing one year and then two different things the next year. He had been a total of 3 different entity types during this time period. Like, think about what a giant mess that would have been if it had gone to the tax preparer without the bookkeeper knowing that he had changed entity types 3 different times. So do not just listen to the client. The client didn't even realize he had done it. Get the documents. So why is entity type important? Distributions, draws, and dividends aren't just different names for the same things. They have different rules, like whether distributions need to be proportionate to ownership percentage, going back to that operating agreement, or whether they're taxable dividends, right? Very different things. They mean different things. And how we log them and what we do with them in the books changes depending on what thing they are. And the client doesn't know. Like, I call it when payroll isn't payroll and draws aren't draws and taxes aren't taxes, right? They often have no clue whether something should be W-2 versus distributions, or estimated personal taxes versus corporate or pass-through entity, PTE taxes. And taxes are different for each entity type. So that means how things are tracked in the books might need to change depending on it. We already talked on proportionate distributions briefly, and often we've also got the equity section on the balance sheet right there at the bottom of the balance sheet. That needs to be specific to the entity type, especially If they're tracking stuff in equity sub-accounts like estimated taxes or vehicle use or home office, because those aren't treated the same for each type either. So we've proofed the balance sheet. Now we're going to look at the P&L. I like for small business owners to use their financials to make real-time business decisions for managerial purposes, not just to get their taxes done once a year. So personally, I think reviewing the key profit and loss accounts every single month is really important, with the accounts that are most important for that type of business, right? Like in their industry, in their region, with their entity type, and so on and so on. But that is not what I am talking about here. So you remember the accounting equation that we talked about earlier? So because of this, you don't need to look at the detail of every single P&L account. It's not like the balance sheet. It can be helpful to run period over period comparisons or use something like Keeper to make sure that you can explain any inconsistencies or jumps up or down so you know you haven't misclassified anything. But from a tax perspective, all we really care about within reason are the accounts that are taxed differently or transactions that should be sitting on the balance sheet, not the P&L. Those are the only things that we care about. Which brings me to payroll and benefits. Reconciling the payroll on the P&L to the W-3, which is the summary page for the W-2s, that means adjusting for tips, since they're on the balance sheet, and various benefits that aren't taxable for income tax purposes. And this is an area that we see the IRS audit because they get W-3 info from the Social Security Administration, and their computers can easily compare that line on the return against it. And when they send that letter, you write back and you say, yeah, there's a difference. Of course there's a difference. And you just send them your work papers. You send them your reconciliation. Here you go, done. It's a lot easier for us than it used to be because we actually use Gusto plus Gusto benefits plus guideline together, and they sync really well. So we're finding way fewer discrepancies here than we used to, and it saved a lot of headaches. But you definitely are going to want to have a reconciliation, just making sure that when you take that wages and salaries line and your officer compensation line and all of that from your profit and loss, that when you adjust that W-3 for all the things that need to be adjusted out or in, they match, yay, or they're within reason. They don't have to match 100%, but it's great when they do. Reasonable compensation. This is one of my soapbox issues. All my Ask CPA people are like, oh God, not that again. An S-Corp shareholder that works in the business has to be paid as an employee the amount that they would have to pay someone to do their job. But they also wear so many hats that it can be really hard to figure out. Or they heard from their uncle's friend that creating an S-Corp will let them avoid self-employment tax. So there are those people too. And the IRS is hip to this. So they're targeting it in audits. And it's fine if you don't want to be the person to determine what their salary can be, though I can teach you how. But you should notice if they're not taking any. Okay, notice if they're not taking any. Both you and the CPA need to be looking at this. Or if it's tiny compared to their distributions. And if they tell you their uncle's friend said that they could, maybe suggest they talk to a professional about it. I personally use RC reports to calculate this. Reach out to me if you want a discount code and a referral link, because I have those. And I believe bookkeepers are better equipped to do this than tax pros. I really do, because they tend to know their clients better and have more frequent touch points. We did a whole session on this in Ask a CPA, and I often present on it at conferences. So reasonable compensation, please pay attention to this. PUCC and S-Corp medical, that's another area. Personal use of company car, that's what PUCC means. They have weird ways that they need to be shown on the W-2. Now, again, you don't have to calculate this, but you should be noticing if they have these things and suggest that they talk with their tax pro or their payroll company about it before year end. Because most tax preparers don't connect with their clients throughout the year, although I wish they would. And for the tax pros that are on this call, This is you. If you're like getting in touch with your clients on a quarterly basis, make sure you're looking out for these kinds of things. It's too late to reasonably fix these things at tax time.
Nancy, we've got a couple payroll related questions if you want to
All
tackle.
right. Yeah,
Um,
let's see what we got.
Awesome. Giselle's asking, what if payroll reports don't match P&L because P&L is on accrual basis? Is that an issue or not as long as I have a reconciliation?
As long as you have a reconciliation, there is no problem with that. The importance is just having the reconciliation showing that, yes, I looked at this number, and once we adjust our P&L to cash, then it matches, but you don't actually book those changes on the P&L. These are all just reconciliations. Think about it this way. It's kind of like when you do a bank reconciliation and you have a bunch of deposits in transit or checks that haven't been cashed yet. Those are reconciling items. This conversion from accrual to cash, reconciling item. Tips, reconciling item. Things that are non-taxable, reconciling item. Yeah.
Great. And then Deborah asks, do you recommend we use the IRS site to verify the tax numbers to the vendors and employees?
No, we don't do that. Do you mean like on 1099s, or I'm guessing you mean on 1099s? We don't do that. I think you probably could, but it's their responsibility to provide that information to you on the W-9. And if it's incorrect, that's really their problem. Yeah. I have a whole thing on 1099s. Actually, I've got tons of them on my presentations and podcasts thing. That's one of the things I present on. I will say I do pay the extra when I'm using Track 1099 for the TIN and name matching to verify those are correct, but I'm not going through and like looking it up on the IRS website, and it's not required. You don't have to. It's just a best practice, and I'm not going to do that work. I'm going to let Track 1099 do that work. All right. What's deductibility got to do? Got to do with it. Not all expenses are deductible for tax purposes. That's how we end up with book income versus taxable income. You got what I call, these are my terms, these are not like industry-wide terms. You got fully deductible, but not here, like home office. It's not deductible on their entity return or their Schedule C. It's deductible somewhere else. You got partially deductible, like meals, 50%. And then you got non-deductible accounts, like entertainment. And it's important to know what they are, because you want to make sure they're not commingled with accounts that are normal, plain old, regular deductible. You might even want to call out what these are on the chart of accounts with like a little parenthetical afterwards. So like meals, 50% deductible, or entertainment, non-deductible, or penalties and settlements, non-deductible, right? Like you can put that on there. So some examples. We already talked about entertainment and meals, but think about meals versus firm function. It can be called firm function or employee recreation. These types of things are the like once or twice or 3 times a year where you have like a firm-wide thing that is happening for everyone, like an annual picnic or an annual holiday party. Those kinds of things, those are 100% deductible. So you don't want them in the same account as meals, right? You want that to be in a separate account. And that is a way of communicating with a tax pro that we don't really think of as communication. How our chart of accounts is listed and which things have separate rows and which don't, that is a form of communication, because they're going to see meals 50% and they're going to see firm function / employee recreation 100%. And they're going to understand the difference. And if they look in there, or if you write them a note, you can say, I confirmed that this is just the annual picnic and the annual holiday party. All good. They're not like sliding their weekly pizza party in there at the same time. Another example is charity versus advertising and promotion. There are a lot of times where a small business will contribute to a charity, but it wasn't just out of the goodness of their heart. They're contributing to the charity so that they can get advertising, so that they can be on the sign or in the program or have their name on the t-shirt or be announced or get an opportunity to speak in front of their target audience. There are a lot of reasons that they might give to a 501c3 charity, but it's not really charity. You want those to go into advertising and promotion. because in a lot of entity types, charity just flows through onto their personal return. And if they don't itemize, which most Americans don't, then it gets lost. They don't get to take that charity deduction. So we want those things to be an advertising promo. And if you write a note to the tax pro on that row, when you've exported the profit and loss, you can say, there are some 501c3s in here, but the client got something in return. That's why it's here. Right?
You have time for a couple questions, Nancy? Sorry.
Yeah.
Okay, great.
Yeah, sure.
Deborah asked, can those be used on a solo prop?
Yeah, totally.
Awesome.
Absolutely. Absolutely. 100%. Easy
Great.
question. Love it. All right.
And then-
penalties. Oh, sorry. Go ahead.
Sorry, one more. Aura asked, should our COA mirror in most ways the Schedule C or 1120, depending on our client's income?
Yes. Aura, that's one of our wonderful members. Yes, Aura. Absolutely. It is so beautiful. Here's what I recommend. When you're creating the chart of accounts, pull up the entity tax return, just like a blank copy on the IRS website. Or if it's a client that's had this in the past, pull up theirs because you can see which ones they use. And any of those that they should be using, like if it says if depletion is on there and they're not like an oil or gas company, then don't put depletion in your chart of accounts. You don't have to have like every single one of those is in your chart of accounts. Every single one of those that they use or should be using should be a separate line on the chart of accounts. And then any additional lines on your chart of accounts are for you to help your client actually manage their business. So charts of accounts that are like a million pages long drive me nutty because the ideal chart of accounts, if you're just preparing a tax return, is only one line each for each of the things that's on whatever their entity return is that they use. And then the ideal chart of accounts for somebody who actually wants to use their financials to make intelligent business decisions, which is what I would like for them to be used for, is to start with that version and just add in things that would help them make an intelligent decision. If a piece of information is helpful for making that decision, add a line for it. That's what we should be doing.
And then
all right,
one more.
Oh, one more. Okay.
What about determining deductible travel expenses? It's not always straightforward, as sometimes the trip is for both personal and business use. Do we do the hard work to determine the business portion of the trip, or do we just let the tax accountant know to keep an eye out for the account? Or would you advocate for sub accounts?
Yeah, so I would personally, like in our firm, the way we would handle that is if we know ahead of time that it was a portion of it was personal. And by the way, the difference between how travel is deducted when you're splitting it between personal travel and business travel on one trip, they're different, whether it's domestic travel or international travel. I don't have time to get into that right now. But you know, like that's the kind of thing that we answer and ask a CPA is these weird nitty gritty things. So once you know the rules for each type of travel, and you know that something is a portion of it is personal, I would just take that part out and put it to distributions, just like split the actual costs into the personal and the non-personal, and then make a note for the tax pro, letting them know you've already done that. That would be my recommendation. Otherwise, just let the tax pro know. If you don't feel comfortable doing that, just be like, I don't know what the rules are, but I know that this was part personal. But again, then you're shifting something onto them during busy season. So think of that being your underlying rule. Like, am I making more work for the tax pro unnecessarily? And if you don't know the rules, for example, and you're not an Ask a CPA and you can't ask me, ask them, but ask them in like, you know, today in October, not in March or April. So let's see. I got to move on because we only got 10 minutes left. And I still got so much good stuff for you. Penalties are non-deductible. Keyman insurance is non-deductible. The reason that Keyman insurance is non-deductible is if it gets paid out, so the owner really does die and the business collects the proceeds for that Keyman insurance, those are non-taxable. So that means that the payment for the Keyman insurance, key person insurance, I got to change that. Yeah, you understand how that works. Can't be. 1099 issues. I got so many issues with 1099s. This title's a tip of the hat to Jennifer Diamond from her amazing resource, 1099problems.io, which I absolutely love. I got issues on both sides, 1099s received and 1099s sent. We kind of sort of tie out 1099s received to sales, but we don't do it to the penny. We just make sure that the revenue in QBO or zero is equal to or higher than the total adjusted 1099s. And then we're all good if the IRS comes calling, to go back to that question earlier about, like, do we actually make these adjustments on the books? No, it's just in your work papers. It's just a reconciliation. So what we do is this. 1099 NECs aren't bad. They're fine. They're pretty straightforward. Add up all the 1099 NECs. Then you've got your 1099Ks. They include a lot of non-taxable receipts. So you got to subtract sales taxes collected for the year, tips collected for the year, gift cards purchased for the year. And they also don't account for refunds. So you also want to subtract those. And if that number is equal to or lower than what your sales line is on your profit and loss, then you're fine. You're fine. You'll be good. If the IRS comes calling, you say, no, it's fine. On the other side, did you or will you issue them? The 1099s that have to be issued. It's a question on tax returns. I can check it if I know they're gonna. I can check mark that box if I know they're going to in the future, even if they are way late. So like those October 15th extension folks, definitely better late than never. If they're like, oh no, I didn't realize I had to issue a 1099 to that person and I'm filing their tax return on October 15th, I can check, did you or will you? And then the next day, we're going to issue a 1099 for the prior year. And that vendor is going to get annoyed. But I'm going to say to the vendor, look, it's your responsibility to report this income, whether or not you get this form. This is not our fault. This is your fault. This is your problem, right? That's how that works. Not just 1099 NEC issuing, make sure your clients have taken care of the MISC and the int and the div. Those are really easy to miss, especially those divs. If a C Corp owner pays for something personally and it gets classified as a draw, well, that's really a taxable dividend. And now you need to issue them a 1099-div. Woohoo! Now we're done reviewing. We got to tell somebody what we have done. There are lots of ways to communicate that we don't think of as communication. So don't underestimate memos, descriptions, and attachments. Those are real. Those are beautiful. Receipt management is like one of the most gorgeous things that bookkeepers can do for clients and tax preparers. It is just so beautiful. And to send over your notes and your backup, you can use a massive Excel file with each tab as a work paper or lots of files noted on a checklist. One thing I can say for tax preparers, they generally do get the importance of documentation. But when it comes down to it, the personality of the individual tax preparer is going to determine the method. Some folks aren't tech savvy and some aren't people savvy. Okay, so how you decide to communicate with that tax pro will have a lot to do with who is that tax pro and what does your relationship look like. You could schedule a meeting or a phone call to go over it before tax time, or invite them as a user in your software like Keeper, or PMs like Financial Sense and Canopy, or you could use Smart Vault, which is one of our sponsors, for collecting all of this data, right? So that they can participate in your process instead of making you fit into theirs. And for the tax pros on this call, be open about that. Be open about the possibility of being a user on your bookkeeper's software, or invite your bookkeeper to be a user on your software where you're tracking this kind of stuff. It's a case-by-case basis thing. I mean, that's the point here. So what's important? What do you need to highlight or do for them? We talked about reasonable compensation issues. If the tax preparer doesn't know how to calculate, find somebody like me who does, or join Ask a CPA and learn how to do it yourself. I just think it's so important. And bookkeepers have a more personal relationship with the client. Reasonable compensation calculations are totally in your wheelhouse. Asset acquisitions and disposals. Give them an export or a list to make it easy for them to enter into the software. Just make sure that the client has a capitalization policy and that you know what their threshold is. It can go all the way up to 2,500, but not all clients are going to use that. We have our junior bookkeepers check for a signed capitalization policy on, like, to see if all of our clients have one on record. And if they don't, they send them one and they say, here, because we are deciding their capitalization policy shall be 1,500. Well, what if the tax pro is using 2,500, right? So talk about those things. I had a client's tax preparer journal entry everything out of repairs and enter it as one big asset. No joke, right? Like, don't let things like that happen. Lock the books. Lock the books as soon as you give them the go ahead. Oh my God, the horror of starting a tax return and realizing that the retained earnings has changed partway through preparing that return, or worse, last year's retained earnings has changed since you prepared last year's return. So locking the books also means they're going to have to reach out to you if they want year-end adjustments booked. But like I said earlier, I think they should be doing that anyway. Which leads me to the question of who books them. In my opinion, the CPA needs to give these to you or at least ask permission to book them. And yes, you do need to understand the journal entries. You do. If they won't explain them to you or don't have the communication skills to do so, find someone who does, because in a sense, these are your books and you cannot trust that they'll know the best way to book something. They'll cram anything into a journal entry. I'm guilty of it too. It's just like how we learned to think of things. I once saw a place take an entire monthly bank statement and enter it into QBO on the last day of every month by way of a single journal entry. No joke. So, how do we learn to speak CPA? It starts with trying to work with tax pros who respect your work. I know that's hard at first, but as you build relationships with the good ones, they'll send more work your way. And to try to that end to work with tax pros who care about quality. I know it's hard at first, but eventually over time, you can encourage your clients to go elsewhere. We've heard some really amazing success stories from members of Ask a CPA doing this. Um, and regardless, it all comes down to coordinating and communicating, whether that's with memos and descriptions and attachments, or understanding those tax adjusting journal entries, or making PNYs, that is point for next year. That's what our tax specialist names the file. If you want to, like, something happens and you have a file you want to make sure you refer to when you're preparing their returns next year, she calls it PNY. I call it, hey, Nancy, look at this on January 25th. Like, I will actually name the file that, but whatever. These are notes to your future self to make sure you're bringing these things up with the CPA the following year. However, do not wait until March or April. Reach out to them regularly, touch base, ask questions, tell them about your new plan with the annual review and the work papers. Check in with any questions before the holidays get hectic. It is really hard, y'all, to be nice to other people when you're sleep deprived, which is what you'll get in March and April. Ultimately, you are not alone. This is not only totally in your wheelhouse, you were born to do this. Poll question number 3, will you commit to leveraging at least one system, technology, or tool before year end that will improve the handoff of the books for tax time? I think you know the answer to this one. And while we're waiting for everyone to answer, start thinking about what you've learned here today, or maybe about what you already knew but needed inspiration to actually take action on, and think about what you're going to do differently. Pick the lowest hanging fruit. You do not have to shoot for the stars. I know that's a mixed metaphor, but you know what I'm saying. In my own firm, where we do both tax and bookkeeping, we had to set up systems for our teams internally to do all the same things I'm talking about here. We fixed one thing one year, one the next, and so on. And eventually we got to the point where we have a pretty good flow. Oh man, okay. I think that's a yes. I think that's a resounding yes. I would say that we have time for questions, but we don't. But it looks like we got to answer most of them throughout the course of this. That's just my contact info. Again, if you didn't get it first time around, I really appreciate all those thoughtful questions and that you took time today to spend it with me. Remember, you hold the key to a better tax season for your clients. Let your skills lead the way, and you will be their hero. Thank you so much for coming to Insightful Accountants Future Forward. Please tune in tomorrow for the hidden cost of disconnected systems with Chad Helmlinger. I'm so glad you joined us today. And Emily, I'm going to ask you or Matt for an export of the chat and the Q&A from today, because there was a lot I didn't get to see because it went by too fast. And There's some really amazing comments. I mean, this was just an incredible, incredible crowd, and I feel so honored to have been here with you.
This episode of the Accounting Insiders podcast is brought to you by Insightful Accountants Be Insightful membership program. Get 9 expert-led training tracks, over 30 CPE hours a year, hands-on workshops, and year-round premium content to grow your skills and your practice. Learn more at blog.insightfulaccountant.com. Just click the Premium Member Content button.